Welcome back, everyone. If you own a shop, a house, maybe an apartment that you're currently renting out here in Pakistan, you are exactly where you need to be. Today's explainer is all about something that directly impacts your wallet. We're going to talk about legally maximizing your rental income by minimizing your tax burden. We'll be walking through a step-by-step guide to decoding the Income Tax Ordinance of 2001. So we're going to show you exactly how to claim your deductions and ultimately shield your hard-earned money. Okay, let's dive into this. I want you to ask yourself a pretty big question right off the bat. Are you paying tax on 100% of your rental income? Seriously, think about it. If you answered yes, or honestly, if you aren't entirely sure, well, you shouldn't be. The reality is, most landlords are unknowingly handing over far too much money to the FBR, simply because they just don't know their legal rights. You see, in the tax world, there's a massive, absolutely fundamental difference between your gross rent, which is just the total amount of cash your tenant hands you every month, and your taxable rent. The law actually does not expect you to pay tax on every single rupee you collect. But because the filing process can be so confusing, that is exactly what a lot of people end up doing. To fix that, here is our roadmap for today. Number 1, the rental tax trap. Number 2, unlocking Section 150A. Number 3, the ABC building example. Number 4, Section 155 withholding. And finally, number 5, turning refunds into wealth. Section 1. The rental tax trap. How rental income is treated today. So, to understand how to save your money, we first have to understand how the rules of the game have shifted recently. A few years ago, rental income had its own separate, specialized tax rate. It was kind of kept in its own bubble. But that's no longer the case. Today, your rental income is combined with your normal salary or your business income, and all of it is taxed at the normal standard slab rates. It literally all stacks together. So if you're pulling in a good salary and you just dump your gross rental income directly on top of it, you might accidentally push yourself into a much higher, much more expensive tax bracket. Because of this, finding legal deductions isn't just a nice little bonus anymore. It's absolutely critical. Section 2. Unlocking Section 15A, your legal deduction toolkit. Now, Section 15A of the Income Tax Ordinance, this is the absolute hero of our explainer today. This section essentially treats your rental property like a legitimate operational business. Just like a real business gets to subtract its operational costs before calculating profit, Section 15A lets you deduct specific expenses from your gross rent before you ever calculate your tax. So, here is your checklist of the 5 key deductions the FBR allows. Step 1, repair and maintenance. Step 2, insurance premiums. Step 3, property tax, specifically the one paid to the excise department. Step 4, loan interest, assuming the loan was explicitly used for constructing or acquiring the property. And finally, Step 5, collection and legal fees. Now, the really crucial point here is this 20% number. For that very first category I mentioned, repair and maintenance, the law grants you a flat 20% deduction straight off the top of your gross rent. And the best part? You don't even have to do the math yourself. When you log into the FBR's IRIS portal and punch in your gross rent, the system automatically calculates and subtracts this 20%. It acts like an instant tax shield. You do have to be a bit careful with the other categories, though. While things like insurance, property tax, and loan interest can be deducted based on the actual, literal amounts you paid, collection and legal fees have a very strict cap. The law limits these specific miscellaneous charges to a maximum of 4% of your total gross rent. You can absolutely claim your actual expenses, like, say, paying a lawyer to draft up a rent agreement, or even fuel for driving out to collect rent, but only up to that 4% ceiling. Section 3, the ABC building example. Seeing the math in action. All right, let's move away from theory for a second and see how this builds into real-world savings with a practical case study. Let's imagine you own the ABC building. It brings in 1 lakh per month, meaning your annual gross rent sits at 12 lakhs. Now, let's apply our Section 15A deductions to that. First up, that flat 20% for repair and maintenance instantly knocks 2.4 lakhs right off the top. Then let's add in an assumed $25,000 for insurance, $30,000 for your property tax, and, say, 1 lakh in bank loan interest. Let's also pretend you had $30,000 in legal and collection fees, which, by the way, is safely under our 4% limit of $48,000. Add all of those up, and your allowable deductions total a fantastic 4.25 lakhs. So instead of being taxed on the full 12 lakhs, you subtract that 4.25 lakhs, which brings your final taxable income down to just 7.75 lakhs.
And this brilliantly illustrates the sheer power of Section 15A. Out of your 12 lakhs in gross rent, a massive 4.25 lakhs is completely tax shielded. It's protected. You are only paying your tax slab rate on the remaining 7.75 lakhs. Literally, just by knowing the rules and following these steps, you've significantly dropped your tax liability.
Section 4, Section 155 Withholding, the tax collection reality. So, now that you know what you should owe, let's talk about the slightly messy reality of how tax is actually collected from you during the year. There is this fascinating structural mismatch built right into the system. Under Section 155 of the law, your tenant is actually required to deduct withholding tax based on the full 12 lakhs gross before they even hand you the rent. But, as we just proved using Section 15A, you only actually owe tax based on the 7.75 lakhs net. The catch is, the tenant's calculation doesn't know about your insurance, your property tax, or your loan interest. They just see the gross. So, what does this all mean in practice? Well, it basically guarantees that you are overpaying your taxes throughout the year. Because the tenant is withholding at a higher bracket on the gross amount, by the time you sit down to file your return and claim your legal deductions, the FBR actually owes you money. Yes, you heard that right. You have successfully created a mandatory tax refund. Section 5. Turning refunds into wealth. Strategic tax planning. Which brings us to our final and honestly most strategic phase. Having a refund on paper is great, right? But getting cash back from the FBR in Pakistan can be incredibly difficult and honestly super time-consuming. So what do? Well, you play the long game. Tax experts generally advise avoiding the fight for a delayed cash refund entirely. Instead, you want to use that locked-up refund strategically. First off, you can adjust this refund against the taxes you might owe on your salary or your business income, which effectively wipes out those bills. But secondly, and way more importantly, you can use this refund amount to justify a higher taxable income on paper. This legally increases your documented wealth, which is often referred to as white money, in your wealth statement for the following year. Advocate Chaudhry Mohammed Saeed actually puts this beautifully. He says, plan your tax return so that this refundable tax is adjusted to increase your legal sources and white money. You see, it's not just about ticking boxes for compliance, it's about strategic wealth preservation. You want to utilize every single legal avenue available to strengthen your documented financial profile. Now, if you're sitting there realizing your returns probably haven't been fully optimized, there are professionals who can step you through the whole shebang. Advocate Chaudhry Mohammed Saeed and his team over at Jinnah Tax Lawyers in Lahore specialize in exactly this kind of meticulous tax planning. They handle everything from income and sales tax to FBR matters and property disputes. So if you want to take your tax planning to the next level, you can reach out to them directly. Their contact number is 034-1125-9762, or you can shoot them an email at ms86@gmail.com. We've definitely covered a lot of ground today, everything from the traps of gross rental taxes to the really incredible step-by-step utility of Section 15A deductions, and of course, the strategic power of withholding refunds. So I'm going to leave you with this final thought. Every month you wait to optimize your rental taxes, you are essentially tipping the FBR with your own wealth. Will you let your hard-earned money just sit on the table next year, or will you actually use the law to build your empire? Take action, structure your deductions, and make the tax code work for you. Thanks for joining me on this explainer, and happy learning.